Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here today, as on this lovely Friday in March. Actually, it's not so nice here, kind of cloudy and dark, but it's going to get nice. Looks like over the weekend here in the Cincinnati, Northern Kentucky area. A hell of a lot has happened this week, so we got a lot of data to share with everybody, including a whole bunch of historical data as well. So I'm definitely excited and prepared as usual. We're going to get a lot of news here as well. We got jobs news this morning that came in pretty good. We're going to hear from the White House. It looks like here any moment. We're also going to hear from Fed Chair Powell in a little less than 90 minutes at about 12:30 Eastern Standard Time on his thoughts regarding jobs, inflation, the economy, and probably laying out some expectations regarding future Fed meetings coming up this month as well as May. So we'll talk about that as well. And then we also have a major crypto summit going on in Washington that could cause some market movement here as well. So plenty to talk about today, Ez. Very excited. Kind of be a little bit all over the place here today. Data heavy and ready to go, especially after our just amazing client event. So it's good to be back here doing our thing for the Financial Shepherd podcast. Please like, share, subscribe to our show. And before we get started, has anything on top of your mind here today, man, that you want to make sure that we start with, or just in general thoughts on the client event that we had last week? Anything like that on top of your mind here this morning?
Yeah, I mean, client event was wonderful. It was banging. It was really great to meet a bunch of the listeners of the show. You have a lot more interaction with all the Shepherd Wealth Management extended families, I like to call it. I
Mhm.
primarily only engage with them whenever they engage with the podcast. So it was really great to see a lot of faces and meet a lot of folks. Awesome night. The venue was spectacular. Food was incredible. You gave a really informative and heartfelt presentation that I know really reverberated with everybody. So, yeah, that night was one for the books, man. It was kind of our first ever major company SWM gratitude for the client thing.
Yeah, yeah. I think it was timely too, given all the volatility that's happening here in the market after just a really good start to the year. So it's nice to be able to get in front of a large audience of clients as well as guests that are a lot of them are now clients or are slowly becoming clients here as we're talking. So it's been fantastic. It's been an honor and a privilege to be able to do something like this for customers across the United States. And that's part of the reason why we do this show as well. Is the news does a really good job of scaring the hell out of people, and I say that half joking, but half in reality, without any um, ill will towards the media, because the media is in business to make a profit, and so am I. And I have nothing wrong with any entity or anybody going out there and making money. I have no issue with that whatsoever. I'm a capitalist for sure. But what I do have an issue with relative to the news is they understand this thing called behavioral finance. They probably all have a PhD in it. They have to. And if they don't, they just stumbled upon this by happenstance and it's worked out really well for them. They just repeated it over and over across the decades. But human beings are who their customer is in the news media. And what the news understands about human beings is they're all hardwired with these emotions called fear and greed. And you can actually get a PhD from every major university these days regarding this field of behavioral finance. And it really does a good job of helping us understand how human beings make decisions, especially with their money under quote unquote stressful circumstances. We'd like to believe that we're all very non emotional and very rational beings. But the reality is, and science has proven this, is that we're all hard with these emotions, the two most powerful being fear and greed. And what we found from this study is that human beings feel losses twice as much as they feel good about making a gain. Of course, the news understands this, of course, that we're risk averse by nature. And that's why most of the headlines are more fearful than happy. And it's really because they want you to be as engaged as possible. And they know that that fear side of every human being is twice as engaged as opposed to when they feel happy. And that just keeps your attention on their programs longer, which allows them to sell ads and keep them in business. Again, I have nothing wrong with any of that. I consume probably more news media than is certainly healthy. And it's also part of my job too. And I understand what they're doing. But what we try to do here at Shepherd Wealth Management, and why you should like, share, and subscribe this channel, is because yeah, we say, hey, this is what's going on. Here's what the news is right now, this week, right here today. Here's why the news brought it to your attention and why you should find it important or valuable. But more importantly, the most important thing is there's always been a historical precedent. Whatever it is that we're excited about or whatever it is that we're freaking out about, there's always a historical precedent. The one exception, global economy for a couple years when the pandemic happened with COVID-19. Other than that, you'll have a very difficult time, an impossible time convincing me that there's no historical precedent for whatever it is that the news wants to talk about that day, that week, that month, that quarter. And why that's so important is the stock market, the market is made up of human beings. So if you can understand how other human beings have behaved under similar circumstances that we're going through right now, that does two very powerful things for you. It does the very first most important thing is it gets your emotions, your temperament under control. Once you understand how other human beings have behaved, you get a really good, clear understanding of what the risk and reward is for any investment decision that you'll make. And I'm about to come back around to the investment decision part of this. That's very important, of course, for sustaining success. But the number one reason, Warren Buffett, who is arguably, or not even arguably, the greatest investor in our generation, hands down, not debatable. His average performance for shareholders since 1965 is 20%. That's the average. The market over the exact same period of time is 10%. And here's what Buffett had to say um, regarding human beings and their emotion. The number one reason, in his opinion, that individual investors do not achieve the results they're looking for consistently over time is they have no control over their emotion. In other words, their temperament. So if that's the most important thing, that's why we spend so much of our time here at Shepherd Wealth Management understanding how other human beings have behaved in similar circumstances that we're going through right now, because it gives us full control over our emotions. And then the second most important thing it does is it makes it very clear of the 11 sectors that make up the market, what sectors did the best and what was their performance and what was their win ratio? What was the likelihood that this would be an event that would repeat itself under these similar circumstances? What was the overall return of the market of all the 11 sectors combined for the next 6, 9, 12 months? There's a historical number for that as well. We're going to show you guys and share all that information with you here today. Now, past performance is no guarantee of future results, and investing does involve risk, including risk of loss for all the compliance hawks out there. But once you get control over your emotions and you clearly can see what the risk and reward is for every investment decision in every sector of the market that you have the opportunity to participate in, that's a great recipe for sustaining success over a long period of time. Matter of fact, that's an edge that you will have over most investors because the news does not talk about this. I never see anybody talking about this on the news. And if it does happen, it's like for 30 seconds, maybe 2 minutes at best. And it just kind of gets bogged down with all the other, stats and data and, market headlines that you're going to see not only in the news, but on your smartphone. So that's the reason why you would want to like, share, subscribe to this program. That's the edge that we bring for our clients here at Shepherd Wealth Management. And we are an independent registered investment advisory firm serving customers across the United States right now, doing business in 15 states, can do business with anybody in the United States. Our license stops at the US border, and we're SEC registered, $120 million of assets that we manage for clients and growing. So we're very, very excited to be able to provide this edge in helping people get control over their emotions so we can consistently perform for them. And on top of that, we communicate all of this information weekly, if not daily sometimes. We've had the last 10 trading days a ton of volatility to the downside. And because of our mobile app and our technology and our capabilities there, thankfully, because the firm has grown to be able to have these solutions and services for customers, we're right in front of them. Before the news even gets, all their headline scary things out there. Like literally yesterday, right as the market opened, here's what's going on. Here's why it's happening. Here's what history has to say. Here's what we're doing about it. And I'm about to do the exact same thing here today because this is the first week of March and it's newsletter day. So the newsletter is just a longer version of what we send out every week to clients, a weekly blog, usually about a page, page and a half, all of our data that we're using to help make decisions and explaining why we're doing what we're doing in just plain English Today is going to be a summary of what happened last month, why, what history had to say about it, what we're going to do this month, and our expectations kind of going forward. So I'm about to get into all of that today, Ez.
Do
I'm
it.
not even sure how we're going to control this for 45 minutes or whatever it's going to end up being here. But that's what we're about to do. We're about to go over all this stuff. So
It's like one of those
buckle up.
popcorn buckets where you got the cheese, the butter, and then the Cracker Jack stuff all mixed together. We don't know what we're getting when we put our hand in the can.
That's
Something.
right. That's right. It's going to be awesome, though. Is what it's going to be.
Yeah. You're not
Um,
lying about the news, man. I had actually my first in a while wild encounter with a fair and balanced news headline. I was
did
felt
it
like
freak you out?
taking
You're like,
a
what the hell is this?
yeah, I felt like taking a trip to the digital ghost town that is Yahoo Finance on my way to get my horoscope for the day. And
Nice.
I saw a headline that said, investors are worried about current slump in the market. However, dips happen. And I was like, that's about as good as we're going to get.
Dips happen. Somebody really did
Dips happen.
some serious historical research on that one.
Yeah, they went into the bag for that headline. Totally not written by AI, by the way. So,
No, no, that was not an not even close. I might just get a hat that says dips happen, you know?
yeah, that's some serious merch for SWM. Dips happen.
That's a good one. Yahoo Finance. There you go.
Gotta love it.
You gotta give them
Horoscopes, too.
credit, right?
Yeah. Horoscopes
Anyway,
and the finance news of the day is what I use it for.
well, there you go. Another reason why you want to like, share, subscribe to Shepherd Wealth Management. Never know what little tidbits you might pick up here. But speaking of that, I'm like I said, this is a data heavy day. So I want to start with inflation. You're going to hear the Fed talk this afternoon, 12:30, roughly a little over an hour from now, Eastern Standard Time. And current inflation metrics. This is a measure from Trueflation, which is a third party entity that obviously, this is what they do. They look at inflation data and provide more concrete, I would say, more detailed information, even what the Fed's going to provide. And here's what their data is showing: there's a significant easing of inflation. They have inflation pegged at 1.42% year over year. And this is down from 3.2% that Trueflation was showing in January of 2025. Now, this has been driven, I have the data here, driven by falling gasoline prices and car prices. So I live in Northern Kentucky, just outside of Cincinnati. And as I know that you're down in Nashville right now, I know that our audience, like I said, is across the United States. I'm going to go see everybody here in April, in May. So I'll have a really good understanding of what gas prices look like across the United States. But here in this area, man, I mean, we're seeing around 250 or less per gallon, and that was certainly $3 or more not all that long ago. So it's not just the car prices are coming down, but you're also seeing things like gasoline prices fall, and that was a big factor here in the weighting of this data, which this may be supportive of future rate cuts if this starts to be reflected in the Fed's favorite measure of inflation, which is PCE. So our eyes are definitely open for that. That's exactly what we hope to see. Is the jobs numbers came in today roughly in line with consensus. The market was looking for 160,000 new jobs, and we came in today with 151,000 this morning. Unemployment did tick up to 4.1% from 4, but we were as high as 4.2% just a couple months ago. So it's kind of been, hanging out somewhere between 4 and 4.2. Not an issue there at all. That would be defined as full employment. So if full employment remains intact, across the country. And we also have inflation falling, as Trueflation data is showing here. That is a very bullish thing. That's why today's press conference with Jerome Powell at 12:30 is so important. He should be laying out some guidance regarding future rate cuts. The question is it going to be in March or May? And the May probabilities have spiked quite a bit. So a May rate cut probability rose to 45%. And this was as low as 10% just a couple of days ago. Now, with the jobs report today, we'll see how that may have changed, and hopefully, Fed Chair Powell has something to add to that. But this is kind of the best case scenario. This is that soft landing that everybody's talking about. If you can get inflation to fall to 2%, and Trueflation's actually got it pegged year over year lower than 2%, based on their data, If you can get that without destroying jobs, that is the beautiful soft landing that everybody was hoping to have happen. But obviously, from a historical perspective, the Fed has had a very difficult time of pulling something like that off. But it does appear as though that is the case. Again, we have to keep our eyes on jobs. This is one data set. You'll probably hear the Fed chairman say that as well. This is one piece of data. We have to take it all the data in totality, meeting by meeting, et cetera. I think that that's not a bad way to go about doing business as a Fed chairman, is to let the data actually come out and then make decisions based on how that actually has an impact on the economy, jobs, and of course, inflation. So, with that in mind, we also have news that I'm sure that everybody's aware of. The auto tariffs certainly have been paused. I'm going to come back to that. Um, Maybe just a little bit more detail here. But I did want to provide some historical data. So we just got some updated inflation data. And again, this is third party data coming from a third party entity. What the Fed chairman has to say and what the Fed actually does is really what the most important thing is. But there is some historical data that I wanted to share with investors that I think is crucial. I think some people maybe have not have heard these kind of data sets before. So I want to spend a little time on this as, and I'd like to get your feedback too, man. I'm not sure if this is something that you are aware of either. But here we go.
All right.
So investors have, been mindful of all the volatility and historically. When you look at data over just the past 10 years, and I'm about to expand this out to a much wider range of time, but historical data over the past 10 years highlights that missing the 10 best days in the market would transform average annual returns dramatically. And I'm going to give you an example of this as so just over the last 10 years, if you were a market participant investor in the stock market for the last 10 years and you only missed the 10 best days. So I don't
Okay.
know how many days that is over 10 years as 365 days times 10. I guess that's 3,600 plus days, right?
Well, do they mean 10 best days every year or just 10 best days total over 10 years?
10 best days total.
Okay, so over 10 years, you miss one day each year. That's the best of that year. Maybe
Sure.
not even that. Could be a week in a row, right? It's just the 10 best days in 10 years.
Yeah, the 10 best market performing days in
Okay.
all the last 10 years.
Okay.
You with me?
Yeah. So
All right.
10 out of 3,650, give or
Yep.
take a leap year,
Right.
couple leap years.
That's right.
Okay.
So if you would have missed just the 10, so you're a market participant, and let's say that you allowed that fear emotion to kick in on 10 days and you sold. But then you immediately regretted it and bought back. Like just say you missed the 10 best days. You were investing for all the other days,
Hmm.
but you just missed the 10 best stock market performing days. The return difference is dramatic. You would go from a positive 12% by participating in all of the days, meaning that you captured all of them, good, bad, and different. You caught all the best 10 days as well. The performance would have been 12%. If you only missed the 10 best days and then participated in everything else, you were down 12%,
Oh my God.
right? Um, I mean, just sit that and let that kind of like wash over your brain for a second. I'm about to expand this data set to a much wider range of time and make a very similar point here in that this data is screaming, you're an idiot if you're trying to time this market. Okay. Or any market for that matter. Forget this market. This data screams market timing is not going to work out in your favor. And just missing those 10 best days, is evident of that. More importantly, time in the market is much more valuable than trying to time the market. That is a very common saying that we used to share with clients when I was working for the big players, the Fidelities and the TD Ameritrades of the world. That was something that we regularly talked about with customers to try to help them, understand the risk that they're taking if they feel that they're a little smarter than everybody else. Now, if you expand this data set to 1928, so the same rules apply here. Talking about the 10 best days from 1928, January 1st, 1928, all the way through today. The average return or the return for the S&P 500 investors. So you participate in the S&P 500 from 1928 to today. Your return is 8%. If you only missed the 10 best days since 1928, but you participated in all the other ones, your return is negative 13%.
Wow.
Okay. So this is evidence. This is historical data. This is human beings' behavior. And unfortunately, due to the market volatility that we're seeing right now, investors are allowing that fear part of their emotions. If we're all hardwired with it, right? You're not a bad person for being fearful. It just makes you more human, right? We're all risk averse by nature. But if you're doing this all by yourself, and you got a job, you got kids, the reason why you're investing is for the benefit of the future of your family and the prospects and the options and opportunities that you'll have in front of you by doing a good job of saving, investing, and working hard. Well, you have these smartphones on you 24 hours a day. I have three daughters, and stuff comes up in life that takes my attention away from whatever it is that I would rather be or need to be spending my time on. I get it. That's why 69% of all millionaires work with a registered investment advisory firm or some sort of certified financial planner like myself. Um, I can go logical, you can go biblical, you can go everywhere in between. But the reality is, every large institution that was ever created, it all started with a founder, an original idea, original investor, original thought, and then expanded into, in some cases, companies like Apple, Microsoft, Google, etc. But once those companies grow and become bigger and bigger, what happens? You need more and more people surrounding you to help make good decisions to keep everything organized. So as your wealth grows, that burden of responsibility also grows. And you throw on those human emotions of fear and greed and a whole bunch of data to sort of filter through on top of real life. Well, no wonder some of the most successful people on the planet have decided to outsource, um, and remove, ideally, all the distraction, all the emotional things away from every investment decision so we can truly get down to business of making things happen for that individual and their household consistently and repeatably and for the betterment of everybody with a lot less stress. So those are the historical data points that I wanted to kind of kick off the show with here. As I know that we talk a lot about data here. I don't think I've ever shared this with our audience, so this may be the first time that you've heard of that. Um, any initial like knee jerk reaction from that? I mean, I know that every time I've laid this on somebody for the first time, it really kind of put them back in their seat a little bit and made them really think about a lot of decisions that have been made over the course of the last couple decades.
Yeah, I've got two, I guess, initial thoughts. One is that it was really surprising that the performance would swing right around like a net zero, like either you're making money or you're not just on 10 days, you're losing money. That's really surprising. And the second thing is that the 1928 one, I mean, I feel like it's hard for me to wrap my head around that if you'd participated in the S&P 500 since then, you'd only be making 8% on your money. It seems like you'd be way higher than that just with the fact that, I mean, I'm sure a share of the S&P back then, I'm not trying to be cute, but it was probably like $2, you know?
Yeah, yeah.
Whereas
I mean,
now it's 5, it's probably like $600 for an open call, I would say.
yeah, yeah. I mean, it's two things kind of happen here for me when I look at that data set. Number one, just participate in the market. It's going to go up. You will make money. You will create wealth for yourself just by participating in the market. I mean, Warren Buffett has repeated this over and over. And a quick sidebar on Warren Buffett before I go down that conversation, as try to not let me forget where I left off, if you could. But I've had the privilege of being able to speak in front of a lot of high school students, juniors, seniors, few sophomores in the local Cincinnati, high school area. Almost none of them know who Warren Buffett is. I was shocked. I started to get into my normal conversation about history and why it's important to control your temperament and all these other things that I talk about on this show all the time. I'd say at best 50% of the people that I spoke with, these students, 16, 17-year-olds, maybe 50% of them knew who Warren Buffett was. So I dropped a lot of knowledge on those kids that were interested in entrepreneurship or going into the field of finance. Hopefully they're getting all of their Warren Buffett books on Amazon right now. or they're probably downloading an Audible version most likely. So anyway, if you don't know who Warren Buffett is, you really need to know, especially if you want to go into this industry and have some confidence, some success, something that other people can, especially those customers that you might be working with a little older. They certainly will have a lot of respect for a young person that truly understands the history of Berkshire Hathaway and Warren Buffett and what he's been able to do, and more importantly, how he's been able to consistently achieve these results. Because when you go back to 1928 to now, here's where I was going with this as if you're just a market participant, the U.S. economy, corporate America, will do all the hard work for you. Now, if you just buy the S&P, of course, you're going to have to live with the greedy part. When the market's just ripping up to the upside, you're going to feel invincible. And then when it comes back down, normal course of correction, on average, you see 3.3, 10% pullbacks in every single market year since 1928. So if you're just buying the S&P, just know that you're going to have to live with the emotions of that roller coaster ride. And the market is not rigged. That's the other thing I take away from this. Corporations, the CEO, the CFO, and their staff, they're charged with one thing, really. And they're kind of two things together, but it's really one thing. That is taking care of their shareholder, the investor, and the only way that you can do that is to take care of your customers. Because if you're just pissing off customers, you're not going to have any shareholders anyway. So those are two things that are married together anyway. Um, so if you're taking care of shareholders and your customers, and you're charged with reporting your results every single 3 months, that's called a quarterly earnings announcement. You're going to want things to go well. Otherwise, you're not going to have a job. Right? You will get fired by the board of directors because the share price is going down. You will get fired by the CEO if you're the CFO or the COO. You're not operating as efficiently. Your margins are getting compressed. You will get fired. So, with that being the backdrop of we're in business to make money, and if you're not helping the shareholders and the customers grow, you're going to get fired. That's the reason why when you wake up January 1st of every single year, going back from 1928 all the way till now, there's about a 77% chance at the end of that year, end of December, you'll actually have more money next to your name than what you started with just by participating. Now, there's also a 23% chance you won't. So you got to have a game plan for that as well. So the market over a long period of time is a wealth generator. It's a terrible place to try to get rich quick, but it's a great place to build wealth over time just by participating in it. That is likely to be the case. And on top of that, if you have any idea of what you're doing, so Warren Buffett would say, buying the S&P 500, diversifying your assets. If you don't know what you're doing and you're not going to seek out a professional like myself, you are better off, buying the market and just letting it ride, and just understand that you're going to deal with the emotions of that. But what Warren Buffett had to say about diversification is this: two things. One is for those who don't know what they're doing. He's exactly right, because he's doubled the performance of the market since 1965 for his shareholders. He was not diversified. His portfolio consists on average of about 20 stocks, and about 80% of the money that they invest at Berkshire Hathaway on behalf of their shareholders, about 80% of that's in five names, almost at all times, unless they're not participating in the market for whatever their rationale is, and they're maybe a heavier weighting in cash, but they're always going to participate in the market to some degree, even if they have heavy cash. And the reason why they're participating regardless is because of the data that I just provided you. They understand that if you miss the 10 best days, your returns suck. They get that, but they're not always 100% of all capital invested in the stocks. So diversification is for those who do not know what they're doing. And diversification, more importantly, is the death of performance. And I'll give you a simple example. The way that performance is calculated, you take the weighting of position one and you multiply that by the performance of position one, and you get a number. You take that number, you add it with the weighting of position two, multiplied by the performance of position two, et cetera, et cetera. So just imagine that equation. You just spill that out over 200 stocks, which, by the way, is a lot less than the average mutual fund in the industry. For those that only invest in mutual funds, you probably have somewhere between 300 to 500 or more stocks inside of one fund. But let's just pick 200. Knowing that that's the equation for performance, and you got 200 individual names inside of your portfolio, and let's say that one of the holdings is Nvidia, which is up, like 500% over the last 3 years or so, approximately. Well, That probably means of those 200 holdings, maybe you had a quarter, 1%, maybe half of 1% at best in a name like NVIDIA, and it goes up 500%. I mean, you're not really going to feel that at all in the portfolio. I mean, you do, but not really. But if you had, let's say, 20 names and NVIDIA was a 10% holding and it goes up 500, you're definitely going to feel that. There's no question about it. So Warren Buffett couldn't be more right. And this is why we spend so much time studying and implementing this exact same sort of process that he's implemented so successfully for his shareholders and for his customers since 1965. Now, I mentioned the 10 best days, and I wanted to provide some actual real life data as to what's going on right now. Because for some people, including professionals, not just a retail investor, but for some people, it's getting a little too hot in the kitchen for them. You're seeing a lot of selling activity, of course. So this is just over the last week, we've seen an unprecedented de-risking from hedge funds during the S&P 500 pullback. Over the last 2 weeks, and this is where all the volatility has been, is in the last 10 trading days. Hedge funds have sold global equities at the fastest pace ever recorded, ever. On top of that, that's hedge funds into the teeth of the S&P 500 pullback, which is now down right around 6-7%. Nasdaq's been down about 10-11% at this point. The retail investor have also capitulated. Apparently, they're also selling into the lows. And when we see this time after time after time in the course of history, is you see earnings. Earnings season was phenomenal. It was a hope that we would see double-digit earnings coming into the first quarter of 2025, and the S&P delivered 17+% earnings growth out of the S&P. If you exclude energy, and the reason why energy might want to be thought of as an exclusion for this quarter is because we all know, I just read it off, that gasoline prices and car prices are falling rather quickly. So if we remove their earnings from the S&P, and they're one of the 11 sectors of the S&P 500 is energy. Energy is one of the smaller weightings. It's about 5% of the overall S&P. So if you take them away and you have the other 10 sectors that make up the S&P, the earnings growth was more than 20%. And on top of that, January was positive. This is something that we wrote about and talked about to all of our customers on the podcast. Is that when you have a January for the full month to be positive, well, for the full calendar year, going all the way back, 1950, markets are positive 89% of the time, and the average performance for the year is 19% on average. So you have awesome earnings. You have the historical precedent of January barometer being positive. In addition to that, I just gave you some inflation data that was good. We just talked about the jobs data that was roughly in line with expectations. I mean, I'm having a very difficult time understanding why individual investors would be selling relative to the actual numbers, the actual data points that have actually happened here. I understand the word tariff freaks some people out. And that's the reason why I believe that all of the selling that we're seeing here is not fundamentally or technically driven in any way, shape, or form. Now we're going to find out here today because the S&P 500 is trading right at its 200-day moving average coming into today. Now we're still waiting on Fed Chair Powell to talk in a little less than an hour as I'm delivering this podcast. So this is definitely going to be a market moving kind of day. Um, but I do think that you're going to get two things by the end of today, and then we'll talk about the Bitcoin summit here in just a second. So two things that I think will actually happen today. I think there will be evidence of a Trump put, and I will think there will be evidence of a Federal Reserve put. So let me explain. Let's start with the Trump put. The White House has previously stated lowering interest rates um, as a measure of success. So they're looking at the 10-year specifically. This is Secretary Bessent coming out and saying that in the short term, success looks like the 10-year note coming down. The reason why that is important is because that particular interest rate measure, the 10-year treasury, is really how a lot of things are based on, including Fed decisions, whether or not they're going to cut rates or not. Because if inflation is in fact falling and interest rates on the 10-year stay roughly the same, well, without the Fed doing anything, they're now automatically tightening their grip on the economy, which is not really what we're looking for here. So that's important that they're keeping an eye on that. The other reason why I think the Trump put is in existence is because of the statements regarding Canada and Mexico tariffs that we found out yesterday, signaling some desire to reduce the harsh financial market consequences. And the White House likely has not anticipated the quote tariff uncertainty and how much that would slow the economy, especially so quickly. And today, meaning yesterday, was the first evident of a Trump put returning. In addition to that, when you look at the first administration or the first Trump administration, this is going back to 2017. The S&P 500 and the Russell 2000, which is the small cap index, they were far better this same time point, roughly 2 months in to the administration. Again, we started out this administration in January pretty dang good until about the last 10 days. So when you look at it just strictly from first Trump administration to now over the exact same time period, you're seeing the Russell and the S&P do far better. Now, I know that he said yesterday that he's not paying attention to the market, but let's just be honest, we're all human beings. We haven't changed all that much in a couple of thousand years. When we say that we're not looking at something, that really means that we're really paying attention to it. It's just like, my kids, when they say that they didn't do something, I must know for certain that they probably did whatever it is they said that they didn't do. So just keep that in the back of your mind. Now, I mentioned rate cut probabilities. They were as low as 10% just a couple of days ago. They're now accelerating close to 50%. And in addition to that, yesterday, Fed Governor Waller is a voting member, and he had this to say regarding tariffs. Waller said, "quote The tariffs are likely to be a one-time increase in the price level, but rolling out tariff hikes at different times makes it harder to tell if prices are going up from tariffs versus the broader market." So this is my point. Tariffs, inflationary, non-inflationary, one-time price hit. They're on today, they're off, they're a partial on. I mean, this is just a confusing message. So I think that the one thing that can be critical regarding the administration's messaging regarding the economy, which is the second most important reason to Americans as to why the election results happened the way they did. First was the border. This is just not my opinion. It's according to actual stats. It was the border and then the economy. So border, let's just put a check mark next to that. Put that to the side for just a second, given the actual stats that we've seen regarding border crossings. Let's just put that aside for just a little bit. Keep doing what you're doing. Seems like that's working. Seems to be that Americans are happy with that. Americans are not really happy with the herky jerkiness of the messaging regarding tariffs, and this is kind of backed up with this statement. Um, for some people, they think it's the end of the world. It's definitely an inflationary immediately. For some people, I don't really necessarily view it as inflationary, and if it is, it's probably a very small blip in inflation. That's exactly what Fed Chair Waller here. And there's a lot of people in between all of that. Again, the messaging regarding the economy, tariffs, pausing them, keeping them, and the actual impact that we're trying to drive with them. All of that has been messaged. It just hasn't been messaged distinctly. And that's causing a lot of uncertainty. And the one thing that we know for sure about human beings is we do not like uncertainty, especially when it comes to our money. So I've given you all the historical data points as to why you would want to continue to be invested, why you would want to buy into this dip. So what we've been doing for customers, knowing all this historical data, knowing the data that's going on right now, um, we have been buying this dip aggressively. Now, we were a little bit more diversified coming into this year for our customers than we ever have been over the last 3.5 years. We came into this year with an allocation to bonds for the first time in 3.5 years. The reason for that is we were anticipating some early volatility relative to some policy decisions that were going to be dramatically different than the prior administrations. I don't think anybody was surprised by that. Um, but this very, very violent sell off that we've seen over the last 10 days, again, based on the data that I've just rattled off here today, you can't base it on fundamentals. You certainly can't base it on technicals. You definitely can't base it on history. The only thing that you can base this on is the actual emotion aspect that individual investors are trying to handle right now. And they're doing that very unsuccessfully because, as your favorite measure, favorite survey, I know that this is what you look at first thing when you wake up every day before you even brush your teeth, say your prayers, or eat any breakfast.
Before my
Uh,
horoscope.
that's right. The AAII percent net bulls.
Percent net bulls. Yes, sir.
That's right. That means there's more bearish people than there are bullish people, at least right now. This is negative 42% as of last week. The momentum stocks, there's actually a momentum ETF. MTUM is the ticker symbol for that. You can look at their holdings. Those momentum stocks have fallen 8% in the past 2 weeks. The VIX term structure has inverted, meaning that people expect more volatility in the short run over the next month versus 3 months out. So we'll see what the Fed has to say here this afternoon, and we'll know for certain whether or not the Fed put is still in play here. But the AAII net bulls being so negative, I mean, we really haven't seen anything else like that from a historical standpoint in a bull market at all. We still are, in fact, in a bull market. Um, you can't argue that point necessarily just yet. I understand that the Nasdaq is in correction territory, but we're certainly not talking about recession, at least not today. So the last time we've seen the AAII retail sentiment this bearish, I mean, you got to go quite a ways back. You're talking like 2008 scenarios here where the market's already lost more than 30%. And other points in time in history. I mean, the best performance in the S&P when retail investor sentiment was this bad was minus 25%. I mean, we're not even flipping close to that. We haven't even hit negative 10% on the S&P 500 yet. And by the way, the data point regarding tariffs, as far as the probability by sometime in May, um, this is coming from Polymarket, and all they do is surveys. Yeah, they do obviously political surveys and polling as well, and they've been really damn accurate. But the probabilities right now by April 30th of 2025 that Trump will remove tariffs on Canada before May went from 30% just at the beginning of March. It's now 60%. So it seems as though the probabilities of that concern that seems to be driving all this volatility and selling from hedge funds and retail investors is causing all this negative retail sentiment is in fact this headline risk that we're talking about right now. It's certainly not fundamental. It's not technical. It's not based on earnings. It's 100% emotional, which is why we have been buying the dip aggressively for our customers. And last but not least, we've got a Bitcoin summit today. Ez, I know that you are a crypto enthusiast. You've been investing in this space even longer than I have. But we do have some stuff coming from the White House today, and I'll give investors what I have right now. I don't obviously, I'm not in the room. I have no idea what these cabinet members are going to be saying here this afternoon. But here's what we do know: the U.S. now owns Bitcoin. That's number one. Number two, it's a strictly Bitcoin strategic reserve. All those altcoins stockpile; those will be held in a separate reserve account, maybe the sovereign wealth fund, but it's not going to be the actual crypto reserve. That's going to be Bitcoin. Number three, the executive order eliminates the idea of using taxpayer money to acquire Bitcoin. And we do like Bitcoin, but we shouldn't be purchasing it while we're running a large deficit. I think that's why that's put in here, and I would agree with that. I think if we can balance the budget, actually have a surplus, how awesome would that be? Is if we actually got back to a surplus here in the United States, then I think that can make some sense for sure. Number four, the second order executive order effects are more important than the 200,000 Bitcoin taken off the market. What they're referring to here is they're going to keep the Bitcoin that was acquired from all the bad actors a couple years ago. So instead of the U.S. government selling that like they did, I believe it was a couple years ago, as if I'm not mistaken, and the selling
Yeah.
of I think it was 160 or 90,000 Bitcoin. I think they got like 332 million from that. If they kept it and sold it today, it'd be worth about 17 billion. And that's kind of the point here with this crypto strategic reserve. A lot of reasons for it, which we will probably spend a full podcast on it at some point. As I know that'll be a big one. I'll
Oh
probably
yeah.
get a lot of viewerships. I know we'll have a lot to talk about. Might even be a long one, but it'd be worth tuning into. So stay tuned to that. We're going to get obviously a lot of news here today. And number five, it further legitimizes Bitcoin for institutional investors who may still be on the fence. So really, the only people participating in crypto assets, Bitcoin specifically, are retail investors. Really not something that institutions have been able to play in. Certainly not pensions, but that's changing. So Texas legislation has now passed a. This is the first state actually to pass a strategic reserve for Bitcoin. I believe that they're passing. I believe they have a surplus, and they'll be using some of the surplus to acquire Bitcoin. I want to say at 5% levels for now, but maybe as much as 10%. So we'll see. Michael Saylor, the strategy CEO, amongst a whole bunch of other cabinet members, will be talking today at the White House crypto summit. So a lot of news that will probably move that asset class as well. I'm pretty bullish about it, as I'm very excited. I think this is a good thing for the country in the long run, and certainly those that have been participating in crypto assets, specifically Bitcoin. That's the one that I participate in. I don't really have much to say about any of the other ones. I like the safety of large numbers, and you're certainly getting that even more so once we actually get some regulation regarding which things are considered assets, which are considered commodities, and who's regulating them. I think that's really where the fireworks start to happen, but you're starting to see all the groundwork happening with states passing strategic reserves. Now the federal government wanting to do it. We need some details for sure about all of that. And hopefully that's what's being laid out here this afternoon. So it could be another market moving kind of day. It should be here in the next 40 minutes when Fed Chair Powell starts talking. As we're talking right now, markets have sold off. This has been happening all 10 days. I've said this to my business partner every single day for the last 10 days. Markets look awesome pre market. By the time you get done with breakfast and so forth, you're feeling great. Go about your day. You get to lunchtime, still feeling pretty good. But then after lunch, it's just been a disaster every single day for the last 10 days, with the exception of one day. One day out of the last 10 days has been solid. But other than that, you've just seen a lot of volatility. And again, I cannot point you to any one fundamental technical thing at all, not a historical data point that would lead me to wanting to sell into all the vicious selling that's going on right now. We will likely be buyers on this dip here yet again today. This continues, and we'll have to see what happens here. But ultimately, as we got through another podcast with dropping just a ton of data on folks, with more information actually to come for investors throughout the remainder of today's afternoon. So stay tuned for all the Shepherd Wealth Management clients. We look forward to communicating with you via our newsletter, and very excited to be doing this for you guys, even amongst all this what feels like a scary moment in time in the marketplace. But I think there's a lot of reasons to believe that everything at the end of the year is going to look pretty dang good for those that were participating, even better for those that had a game plan about how to deal with this volatility. So I hope you enjoyed the show. Please like, share, subscribe to Shepherd Wealth Management Podcast, and we'll do this again in about 2 weeks. Until then, we'd love to hear from you. If you have any questions or comments, feel free to leave them in the chat below. Otherwise, I hope you guys have a great Friday, a great weekend, and we'll see you in 2 weeks, guys.